Hi guys, my name is George Itumo, trading consultant and trader at FourthStreet Consultants. So I take this opportunity to welcome you guys to our webinar, which is on trends, as you've heard Josh say. So after this webinar, we'll hope that you guys will be very equipped in knowing how to trade trends, understanding trends, identifying trends, basically everything trends. Thank you.
Thank you, George. I like that last statement to say everything trends. Well, now on that note, where George said everything trends, actually everything trends in life, literally. Whether it's the weather, we have different weather patterns. Whether it's business, we have different kind of trends. Those who trade in the Nairobi Stock Exchange, you understand how the market trends change. For instance, if it's shares of a certain company, there's a time frame or a season where they do better than the other season. So we have seasons all around us. We have seasons in life. We have seasons where we're doing great. We have seasons where, we face challenges. So life is all about seasons and trends. That's what I'm trying to get at. And today's topic is very interesting because we're going to be applying and see how much trends apply to forex trading and how important is trends to us as forex traders, especially for price action traders, because essentially price action traders like me and you, we base our trading decisions and judgment of the market based on the price patterns, what moves the price. Price action is basically the understanding that as prices move in the market, they form certain patterns, and your understanding of these patterns and how you interpret them to have an edge over the market, that is now the skill of price action trading. And today we're going to be getting deeper into one of the skills of price action, that is how to correctly identify and trade trends. And therefore, once again, welcome to today's webinar. Kindly feel free to forward your questions as we continue covering this topic. And we will really love if you're part of this, and of course we make it an active session. Now let's get right into it. Today we're going to be looking at various topics. We're going to be looking to or I'm just going to pull up a slideshow presentation to just show you a preview of what we're going to be covering, the different topics, subtopics. We're going to be covering how do we tell when trades are developing. We're going to define trends, and then we're going to tell the difference between how to tell between a weak trend and a strong trend. We're going to as well cover how do you know when the trend is almost ending or it's starting to be weak or to develop weaknesses. How do you open trade positions, which is of most significance to us traders, me and you. How do we open trade positions based on trends? And further to that, we're going to also catch up on in case you're a trader out there and you happen to lose in joining a trend that is, as it is starting or as it was starting, how do you then make sure that you come back and get to make a few bucks or catch up on the trend if you missed it in the first place as the trend was developing? And therefore, in line with that, we're going to be covering trend retracements. Further to that, we're going to go deeper, just get a little bit of an advanced level to trends, whereby we're going now to analyze scenarios where you have opened a position and the trend is, you're riding the trend. The old Wall Street saying that the trend is your friend until it changes. And therefore, this is exactly in a nutshell what we're going to be covering. Until what point, what informs us as traders that the trend is about to change or it's about to end? How do we maximize our profits from trading trends? That is, as far as trailing stop losses is concerned. And therefore, I'm going to be introducing a bit of a topic there on how to trail stop losses. That is, if you've opened a position and the trend is showing strength, and therefore how do you make sure that you maximize on your returns based on such a market scenario. We're going to be covering the bounces, the higher highs. We're going to be covering how do we combine trading trends, and as well as following the support and resistance levels, as well as chart patterns. And therefore, it's going to be quite an hour of learning, and I hope you're ready to just grasp the best that you can. And of course, we develop our skills and expertise in the forex market at the end of the day. And therefore, without further ado, let's look at the definition of trends. Simple definition of a trend. As we can see in the PowerPoint presentation that we have shared with you, we define trends as a general direction in which something is changing or developing. Trends occur everywhere in life, in various fields, as I explained earlier, in sports, in fashion, and politics. We have trends in social media, and so on. In forex trading, trends can be described as a general direction or flow of market prices. This is mainly driven by supply and demand, because those of you who followed up the last webinar, this is a point that I discussed, that at the end of the day, the market is driven by demand and supply. For instance, if you're trading a certain currency pair, then it means when the market goes up, the base currency has more, more supply than the other, and therefore it's all a question of demand and supply, and how these two elements balance in the market. Moving on, we're going to trends can either be bullish or bearish. That is, trends can either be bullish or bearish. And what this means is that trends can be, that is, whether prices are increasing or are reducing. That is what we mean by bullish. Bullish is, of course, when prices are increasing and simultaneously the prices are decreasing for the second currency. And bearish is when prices are reducing for the base currency while prices are gaining for the second currency. Moving on, we're going to just cover in a nutshell classification of trends. We have two main types of trends, and this is where we have a one long-term general trend that we call the primary trend, and then we have what we refer to as a secondary trend. What the definition of a primary trend is a major trend or the main trend of the market. We find this mostly happening in terms of the monthly time frame, or more so to the weekly, but mostly on the monthly time frame. This is what gives us a longer or a more elaborate perspective of perspective of where the market, what is the long-term sentiment of the market. Is it a downward trend? Is it an upward trend? It includes the broad upward and downward movement of price. The primary trend could last for several years, from months to years, and therefore that is the definition of primary trend. Secondary trends, on the other hand, is the minor trend. This is it's a decline in a primarily bull market or a rally in a bear market. I'm going to be explaining to you. Actually, I'm going to be, as we always do, as those who followed us on the last webinar, we usually explain points on the slideshow, and then we move to the live market to show you how to handle these, and for your better understanding on how to apply what we're teaching you here in theory in the practical live market using the EGM platform. And therefore, in a few seconds, I'm going to be moving on to the Forex, the MT4, to explain some of these concepts to you. And therefore, this is a manner that I would like us to take this webinar, in such a manner that after I cover a topic or a subtopic in the PowerPoint presentation that is showing on our screen, then I'll be moving further to the MT4 to show you some of these examples on the live markets. And therefore, now that we've covered, before we move on to trend identification or how to identify trends, I've already covered an important element, and that is how to tell the difference between a primary and a secondary trend. I want to move to the market. I want to move to the MT4, whereby I'm going to be sharing with you this classification of the main trend and of course a minor trend. And kindly move with me to MT4, that is the EGM Securities MT4. We identified this element on the pair of the US dollar against the Japanese yen, and this is on the monthly time frame. So allow me to minimize right there, and here we go. And therefore, how do we identify trends? Firstly, we started by saying that we identify trends by we tell the types of trends, then we're going to move further to identifying trends. And therefore, an example of a long-term trend on this pair, I'm just going to delete all these lines so that I analyze the market together with you. This is how we tell a trend. It's simply actually by just a look at the market with our bare our eyes, our open eyes, without even having to do a lot of analysis, as opposed to what some people might tend to take forex as this complicated jargon of an industry. On the contrary, forex is actually, you should take it simple. The important thing is to understand the price, what matters. Follow the market. Don't try to force up yourself into the market. By a mere look at this chart that is open on our screen of the US dollar Japanese yen, this is on the monthly time frame, then we find that we have a downward trend that started from on top here, where I'm going to draw an horizontal line, and this is the general long-term downward trend, which started from the top here on the trend line and going all the way down here until the trend changed, and the bulls took over the market and drove the market, forming yet another uptrend that took place from August 2012 going further up to this point. These are two examples of trends. And therefore now I want to introduce the topic or the element of a main trend, a major trend, and a minor trend. That is the long-term trend. And what we notice on this downtrend that is here with us is that there is this main downtrend, and then within this downtrend we have some short trends developing within the general downward trend. You see that? This is a minor trend that developed in the opposite direction of the major trend going up here. And this is something I want to highlight. And therefore, when we talk about, there's a concept in Forex we call the top-down approach. The top-down approach, allow me to explain this in a second because it helps us understand the concept I'm explaining. The top-down approach in price action and in Forex trading is whereby we analyze the long-term movement of the market based on the higher time frame, that is on the monthly time frame that is usually available on the MT4, and then we analyze the market to try to decipher the long-term trend of the market. And on this case, we start with the monthly time frame. Then we can move further to the weekly time frame and further to lower time frames such as the daily time frame. The whole idea of analyzing or approaching the market using the top-down approach is to make sure that we open positions based on the higher time frame or just the main trend, the sentiment of the market on the higher time frame, because this is the general predominant trend of the market. It's like the way we have a trending market, and then there's a news event that comes about, and then there is spikes happen in the market, and then the market retraces to follow the long term of the predominant trend. So this is the same manner we approach this trading when we're making decisions on trading trends. And therefore, The general sentiment or trend on this pair is that it was on a downward trend during this time, and then there was some short-lived a few months of an upward trend forming within the long-term downward trend. My advice would be to look for incidences where the market is rotating, so that to open sell positions which would be in line with the longer predominant trend. And this is the essence I wanted to explain in this topic of the primary trend and having a primary trend and a secondary trend, more of some small trends within a major trend. And then we move further to identification, trend identification, or how to identify trends. At this point, it is important to know how to identify and differentiate between an uptrend and a downtrend. An uptrend is a series of higher highs and higher lows. A downtrend, on the other hand, is a series of lower lows and lower highs. The following chart pattern, that is the trend patterns that are showing on our PowerPoint presentation, is an example. It's just a presentation of how trends form. And when you talk about a higher high and a higher low forming within a trend, something, of course, I would like to mention at this point is that when we talk about an uptrend or a downtrend, it doesn't mean that the market always has to move on a straight line. Sometimes it does, and those are few incidences where the power of the buyers, that is in the case of an uptrend, and the power of sellers in the case of a bear market, are super strong and have a lot of muscles to push the market, whereby whole candlesticks are forming without retracements. But in most cases, markets don't trend without a few bits of retracement, and we're going to be covering what are retracement a little later within our webinar. And these are examples of how an uptrend forms. It's usually a series of a higher high, then the market subsidizing a bit to the lower, or just sellers trying to convert and take over the market to push the market lower, but then buyers coming up again with their buying power, their bull power, pushing the market up, and therefore forming a series of higher highs and higher lows. Same case happens for the downtrend. We have the sellers pushing the markets or the prices down, but then buyers trying to resist the power or just fight the power of the bull, of the bears. But at the end of the day, the bears take over the day and push the market further down. And therefore it's important to understand that when trends are happening, they don't happen usually on a straight line. They happen, it's a sequence of higher highs and higher lows in the case of an uptrend, and cases of lower highs and lower lows in the cases of a downtrend. And these I'm going to be showing you on the MT4 chart or the EGM platform in a few seconds. And therefore, the next significant question, of course, would be, how do trends develop? And this would lead us to cover the market cycles. This is a period where prices consolidate or range. Then there's no definite direction of the prices, and therefore it's usually a period of indecision in the market. When prices consolidate, they form various patterns, which are commonly known as chart patterns. These patterns, such as breakouts, you remember we covered breakouts in our last webinar, for those who are able to join us. And this is some trends develop out of a breakout, a breakout happening in the market. And of course, I'm going to be covering how do trends develop from breakouts or consolidation or consolidated markets, whereby prices consolidate a bit, and then then a trend develops from such a consolidation, forming a new sentiment or a new trade. And I'm just looking for an example to explain to you what I mean when we talk about prices consolidating and then breaking to a downtrend. For instance, looking at the pair that is open on our chart, that is in the US dollar against the Canadian dollar on the weekly time frame. we see some level of consolidation that happened for several weeks, actually close to 2 months around this level. This is an example of prices consolidating and then, breaking and then further breaking down to just form a downward, a bearish trend. And you see what happened. I want you to notice the candlestick, the pin bar candlestick. We call it a pin bar candlestick. This is a rejection of prices of buyers in the markets. And then, what followed? A candlestick, a pin bar candlestick is an example of a trend reversal, or just a show of prices rejecting, in this case, the upward move. And therefore, what followed after that is a series of weekly candlesticks, thereby forming a bearish trend. And this is what we mean when we say that sometimes trends develop out of a breakout or a price consolidation. This is a period of indecision, and then after quite a period of indecision, either the buyers, now in our case, it was the sellers that broke the prices outside the consolidation to form a downward trend. We're going to be using this example of the US dollar, Canadian dollar, to explain a few other elements as we continue to tackle our topic. At this point, given the fact that we have discussed, I would ask to just bring in George, probably, throw a comment or two, tell us what you think about how trends develop from consolidation, how to this element of trends developing, this element of the major trend, and why it is important to analyze trends from a higher time frame of the monthly, the weekly, just your general sentiments. Just talk to our audience for a second or so.
Okay, hi guys. So about trends and breakout. So what I'd like to add that my colleague Joshua hasn't mentioned, or just to reiterate or second some of the things he said. So some trends do begin from breakouts, and these trends that usually begin from breakouts, if you notice, like the example that Joshua just pointed out on the EGM platform, they are usually quite strong trends. Trends that develop from breakouts are usually strong. We will speak about the strength of trends a bit shortly in a bit. So notice that these trends are quite strong, and they tend to last for also quite some time. So trends that develop from breakouts are strong trends, and they tend to persist. Yeah, that is what I'd like to add about that.
Thank you, George, for taking us through that. George has mentioned a very important topic or element that I'm going to be explaining next, and this is on how do we tell between a strong trend. He's talked about trends that develop from breakout being quite strong trends, and therefore, how do we tell? There's a question of a strong trend, a weak trend. How do we tell between a weak trend and a strong trend? Remember, our essence or our goal as forex traders, especially me and you who take forex as a business, and our goal is to always look for the best chart patterns or opportunities whereby we can spot opportunities that award us more reward compared to the risk amount that we're risking in the market. At the end of the day, no matter how you approach the markets, if you find an opportunity, for instance, yes, it's a trend, but then it's a weak trend, but it's not really, you're not convinced that it's a strong trend enough to open a position or risk your money, then it's always, advisable to exercise patience, to just wait for until probably you get a strong trend, because now and then market will always trend. If this pair is not trending, you can analyze the next 2-3 pairs on your list, and sooner or later you find a trend, and therefore never be in a rush to open positions. Remember, as I always say, less is more in Forex. Unlike these other businesses whereby you need to put in more work, you need to put in more energy, you need to get up early. But this, don't take me wrong, there is work to be done in learning and analyzing the markets. But when it comes to the frequency of opening positions in the markets, less is more. But this, I mean, look for more of quality trades. We look for quality trades other than quantity. And why is it important for us to cover the types of trends of a trend, how to tell between a weak trend and a strong trend? This informs us which is the right trend, which is a good opportunity for us to open positions and place our trade and risk our money out there. And this of course has to offer us a proper risk to reward ratio. By risk to reward ratio, I mean the money that you're risking in opening a particular position at any one time must or should be less, actually must be less than, of course, the money that you're targeting to make, as always to be greater than the money that you're risking. We teach more of these elements in our course, as we have a price action course that is an online course that we offer at 4th Street Consultants, usually available on our website. And this course takes you right from introduction to intermediary. It's actually 60% of the course as videos illustrating the different elements and all you need to know as a trader from beginning to the end. Further to that, we offer consultation to our students. The price that you pay for the course covers for free consultation. You can call our office or you can visit our office to have one-on-one sessions with our consultants. And therefore, we cover more of this even on other topics. Actually, at this point, what if I told you that we have traders who are only trend followers, traders whose main strategy is just riding with the trend, waiting for us trend to come out clear, and then they just ride with the trend. They trail their stops and they trade only when they're sure that this is a strong trend and this is their edge. You master it over time, and this is the essence of price action. Identify a few elements, backtest them, try them in the market, see how well they work for you, then continue to master them, the different elements, how to get the right trade entries, and then make it your strategy. And then work on your money management. How much money are you risking in the markets? What's your risk appetite? And all these elements we cover further in our course. And therefore, I'm just going to move on. There's this element of telling between a weak trend and a strong trend. I'm going to start by showing you or sharing with you an example of a strong uptrend, and this is on the pair of the euro against the Australian dollar. We're going to go to further back to 5th August, and this was on the daily time frame. Now, before even I move to how to tell between a strong uptrend, between a strong trend and a weak trend, something I would like to note at this point is regarding the time frame. And the question, if I was you, if I was a beginning trader or someone listening or tuned into this webinar, would be, we're talking about trends, we're talking about a strong trend, we're talking about a weak trend, we're talking about how trends develop, we're talking about all these other elements that are going to be covered. But at the end of the day, you need to understand on what time frame is it right to look for trends. Mostly, especially at 4th Street Consultants, having back-tested our strategy and trends and how well they, to trade trends over the years we've been in the markets, it's common sense always for price action traders to always analyze trends first from higher time frames, especially on the monthly and the weekly. It's okay to have analyze the market for trends based on the daily time frame and on the 4-hour time frame. But usually the 4-hour time frame, you might identify trends that are totally opposite to the predominant long-term trend that you can find on the weekly or on the monthly. And this is where again I insist on the top-down approach to analyze the market from the higher time frame. Make sure that the trading decisions that you make on your lower time frame, that is on the 4 hour and the 1 hour for those who trade for 1 hour, myself, I mostly make my trading decisions based on the 4 hour going upwards. And therefore, if you have to make a decision based on the 1 hour or the 4 hour or the daily, based on trends, and you're following a trend, always make sure that whatever decision you're making, whether you're buying or you're selling, that you open a position that is in line with the long term, the major trend that we discussed when we were starting. And this you can tell by looking at the higher time frames, that is the monthly and the weekly time frame. And therefore, this is how we approach or we answer the question of which is the correct time frame, to trade trends, or to look for trends, or to open positions or analyze the markets for trends. Therefore, mostly we analyze for trends using the monthly time frame and the weekly time frame. Then we can move lower to the daily time frame to look for opportunities that allow us to open positions based on the higher time frames that we've identified on the weekly and on the monthly. I want to explain to you, give you an example of a strong uptrend, and we move further to the currency of euro, Australian dollar on the daily time frame, and we move back to 5th August 2018. This is an example of a strong uptrend. Right here, where I'm drawing the vertical line, and therefore down here is where the trend started. You see this form of consolidation that happened before this trend formed, and then we see a series of strong bullish candlesticks. This is how you tell between a strong trend. Draw an horizontal line from where the trend has started. You see this line. There is a gradient. This is the angle that is formed within this trend. You see this size of this gradient. As in, simply what I mean is that how steep is the trend? How steep is the trend? The steepness of the trend is what informs us whether this is a strong trend or a weak trend. The second element that helps us tell between a weak trend and a strong trend is how strong are the candlesticks forming, how big are the bodies, how short are the tails. If we have bigger bodies and small tails, as we can see in the series of the 3 candlesticks that formed in the beginning of this trend, this then informs us that this is actually a strong trend. And you see what follows is just a single bearish candlestick, and then more strong bullish candlesticks taking up and pushing the markets up. And this is an example of a strong uptrend. You see the gradient of this uptrend. This is the angle between the vertical line of the trending of the uptrend and the vertical line the horizontal line that we've drawn. This is the angle that informs us how strong a trend is, and therefore the greater this angle is, then the stronger the trend. For instance, let's assume that this trend, the candlesticks formed along this line like I have drawn it. Let's assume this is how the candlesticks formed, and therefore what happens is this gradient changes. It's greater than the former gradient we had drawn, and these are some of the signs that inform us whether a trend is strong or it's weak. And therefore I'll move further to give you to show you an example of a strong downtrend, and this we're going to find on the pair of the euro. The euro again is the US dollar, and this is on the weekly time frame. We screen the market back to 2015. This what we have here. I'm going to draw this. This is an example of a strong downtrend. A strong bearish trend. See from where the markets were consolidating, and then there was a breakout on this level. At this point, there was a breakout to the downside, and the bears took over the market and pushed the markets down. And what you find is that this gradient is what we're talking about. This gradient is quite significant. It's bigger than I'll give you an example of a weak downward trend. That is a trend that has a weaker or a smaller gradient or angle of steepness. It's less steep. And these are some of the ways that we tell between a weak trend and a strong trend. What you find in this downtrend on the euro US dollar pair is that we have a series of bearish candlesticks forming along the as the downtrend was forming, and less of there's actually literal or no retracement of buyers trying to push or fight against this downward trend. And these are some of the signs that inform us whether trend is strong or weak. And I'm just going to go further to our presentation to cover some more items. Before then, we move further to the MT4 to check on some live examples on the markets. I have already covered the concept of the time frame, which is the best time frame. What is why that time frame, why higher time frames, why weekly time frame, why daily time frames, why is higher time frames of the monthly time frame important to us as price action traders. And these I've already covered. And then I'm going to move forward by of course the monthly and the higher time frames. And then how do we confirm entry confirmation on a new trend? How do we enter a position? Okay, now we have analyzed the market. We started by analyzing the market just to refresh for those who are joining us just now. Welcome on board. But we started by analyzing how to tell between the major trend and the minor trend. And then we went further to, how to explain how trends developed, from consolidation, and then there's a breakout, and then a new trend forms. And then I talked about higher highs and higher lows. How do you tell between, it's not always a trend is a straight line, candlesticks forming all the way up. If it's bullish candlesticks, or bearish candlestick forming on the way down for bearish trends. And therefore I talked about higher highs and higher lows, some short retracement that happen within a trend, and I covered that on the MT4. And then at this point, I would like us to cover one of the most important questions of the day. Okay, we have analyzed all that regarding trends, but then as price action traders, how do we enter position? How do we tell the levels of stop loss and take profit? How do we determine which are the right spots, to cover, to set our levels of stop loss and take profit, so that we are guaranteed of a proper or a risk to reward ratio. And therefore, I just want to move with you back to the charts. So I'll take, for example, I'll just go back to this chart that we covered a little earlier, and look at this level. I'm just going to draw this once again, the consolidation that happened on this pair on the weekly time frame before there was a breakout, to the downside to form this downward trend that is going to draw a vertical line. This is a trend we're talking about. But then this level, this horizontal line that I'm drawing across, this was the point of, the beginning of this downward trend. And at what point then would we have, initiated or taken a trade based on this time frame? The break of this consolidation would be our first alert, to take a keener look at the pair. So the bearish candlestick that I'm going to just illustrate right now using a vertical line, this bearish candlestick, this is a bearish candlestick that formed to break, to break out of this consolidation. This would be the first sign to inform us that the sentiment of the market is changing, and that the sellers are starting to prove some, bear power, and they're about to take over the market. But then for those who followed our webinar last time talking about breakouts, the one point that we stated time and time again over and over is that as price action traders, patience is of utmost importance. Normally when a breakout happens and we have such a bearish candlestick, we're not quite sure whether this trade, this trend has already taken place, and that the sellers are, have enough muscles to push the market down. And what we always have to do is exercise patience to make sure that we get a confirmation candlestick. And in this case, on this pair, it's a bearish, a bearish candlestick. And this we got in the following week, given that this is a weekly time frame. So we have the second bearish candlestick that formed after the first bearish candlestick that broke out of this channel or this consolidation. And therefore, on the close of this bearish candlestick right here, this would be our entry point into the market. This is how you tell or how you enter or you open a position based on a trend. You first wait for the trend to form, for a breakout to happen, then wait for confirmation of a second or a third bearish candlestick. But in the case of a bearish trend, and on the case of a bullish trend, of course, you always have to wait for a confirmation, a bullish candlestick confirming that buyers have actually taken over the market and they are about to push. They have enough bull power to push, to fight and the bears and push the market up. And therefore, this level would be our entry point, where we place our position. And it would be ideal to place our stop loss somewhere in the middle of the former consolidation. A stop loss is simply a sign, or for us traders, is a level whereby we accept that we analyze the market, we did our job, but then we were wrong, and we accept that if the market goes against us and gets to this point, then we accept that we were wrong and the markets are right. And therefore, that would be the ideal place to set our stop loss, in the middle of the consolidation. And then, of course, follow the principle of risk to reward ratio and target, at least a 1:2 or a 1:1.5 risk to reward ratio. And this would, of course, given us a nice trade setup. You see what happened after that trade is that there was a strong, not quite strong, but there was a downtrend that took place over the next series of weeks. And, your target take profit could have been hit nicely, and therefore guaranteeing you a nice trade and a nice risk to reward ratio out of that trade. And these are some of the ways that we enter positions based on, on a trending market. Having covered that, I'm going to get back to our slideshow to cover a few more topics. Time is really running. And at this point, I'm going to again plug in George, ask George, to give his thoughts or his ideas about, how to enter positions on trends, and or any other ideas he might have developed or he wants to share with our audience. So for a few seconds, George.
Okay, hi guys. So now we are on the topic of trends and how we can trade trends. So as Josh has said, for breakouts, we wait for the breakout of a consolidation to happen. Once the breakout happens, wait for a confirmation. It is really, really important that you wait for a confirmation, because there are many fake outs in the forex market that come in disguise of breakouts. Many, actually about 70 to 80% of the breakouts in the forex market fail. So in order not to get caught up in some fake outs, which might be really painful, cause you some heavy losses, it is important to wait for the confirmation. So be patient, be vigilant for the breakout, be patient, like I said, for the confirmation, and then once the confirmation comes, don't wait any longer. Get right in the market and ride that trend, because that is how you will make money consistently, low risk, high reward. Yeah, so that's what I can add on our trends and how to trade trends. Yeah, back to you, Josh.
Thank you, George. Be patient like a saint. That was my takeaway for that session. Be patient like a saint. George said it. I mean, you've heard, it's common that it's out there that most traders in the forex markets lose money. Actually, 80% of traders in the forex market lose money. Among factors that lead to this fact is greed, lack of money management, lack of skills in price action, how to, you don't know how to control your psychology, your emotions. And part of that reason, a percentage that traders fail or don't realize long-term success in Forex is because what differentiates you from this 80% of traders? And if you think about that, then you realize that the discipline of patience in the Forex market cannot, I can't overstate the importance of patience in Forex. What George was talking about, waiting for trade confirmation for our entry, is of, I can tell you from my own experience that this has really saved me thousands of dollars in my career, whereby I see this as a great opportunity, but then in the next, a few days or a few weeks, it turns out to be a fake out. Probably was a reaction or a spike in the market, or there is an imbalance between demand and supply in that pair. And then, if you jumped right into the market without a proper confirmation, then you burn your fingers, you burn your capital. And this is not why we're here. We train our students, especially at FourthStreet Consultants. The course that we have is tailored, and it was structured after months and months of research and recording of videos. It was tailored to teach our students to approach Forex as a business. We talk about money management, we talk about the right trader psychology, we talk about confirmation, we talk about raw trading strategies that we teach. And I would advise you out there, whether you're a beginner or you'd like to just advance your knowledge in the Forex market. We cover such topics we're covering today, and even on a broader perspective. And you have the advantage of, accessing up to 6 months of free consultation with our traders at our offices, or you can even call via phone for that. And therefore, I'm observing that the time is really against us, and I'm going to move further to address a few other topics before we analyze some of the questions that we might have from our audience. And moving further, we've talked about entry confirmation on a downtrend. We've talked about, I have covered this in our charts as I was explaining, how to wait for the second bearish candlestick that informs our entry place. And of course, the skill of setting the right levels of take profit and stop loss is a skill that you need to get training from, a qualified or an experienced trader or an institution. And then, of course, further to that, these are experiences you continue to develop the more time you give yourself to trade the markets. And therefore, consistency is of utmost importance when it comes to Forex trading. And this is no different to other, avenues of life, whether it's you're in art, whether you're in your job, whether, it's masonry, whether it's whatever, you have to, pay the time, you have to pay the price. And this is a time that comes with experience, even having the skill of the know-how of your art. And this is no different when it comes to Forex. Trade confirmation and a downtrend, that one we've covered. Moving further, we talked about the trend strength. I talked about how to tell between a weak trend and a strong trend. The gradient, the size of the gradient of the trend. How strong is it? Is it a big gradient, which means it's more steeper and it's a strong trend? And then, of course, the next thing I would like us to cover is how do you know when a trend is weakening or about to end? You know what they say, that the trend is your friend until it ends. But then how do you know? How do we know? How do you know? How do we tell when a trend is actually weakening and it's about to end? I'm going to just move back to our charts and illustrate to you on the live markets, that is using the MT4 platform on one of the pairs, just show you how we tell, or how to tell when a trend is weakening or a trend is almost ending. And I'm going to just use the same pair. This is another example of a gradient. This is the strength of a trend, as I covered earlier. I've just popped up this pair, and I was doing this analysis. We were doing this analysis earlier before we started the webinar. And this is a classic example of a weak trend and a strong trend. I can't help but explain this to you. This is, you see how steep this gradient is in this trend, and how you know, weak or smaller gradient this is. And this is a weak, the second one is a weak uptrend, the first one is a strong uptrend. And this is how we tell between, you know, an uptrend, I mean a strong trending market and a weak trending market. But at this point, I just want to go back to our charts, back to 2007 on the same pair, to just try and explain to you the difference between you know, how to tell when the trend is ending. I'm going to go back further to back in 2007 on the, you know, on the weekly time frame, to just explain to you how to tell when a trend is ending. I'm going to draw a shape just to insert a shape for you, a better illustration of what I'm going to cover just in a second, right here. And then I'm going to draw a line, and I believe you can see the candlestick, the pin bar candlestick that is in the middle of our rectangle that I've highlighted. You see, what we have on this pair is a strong downtrend right here that started from the top, right where I have drawn this vertical line. And this is a very strong downtrend market. And then you see what happened is that at this level right here, there was some form of a rest. We call it a rest. This is a rest in the trend, whereby the sellers pushed the market, you know, started exhausting their energy, and there was some level of consolidation. We call it a rest, you know, a rest in the trend, and therefore the sellers kind of rested. And you know, after a tough fight, you catch some breath. But then this wasn't the end of their strength, and then, you know, they came back with, you know, more rejuvenized and pushed the market further down. But then you see what happened, you know, a few weeks after they came back to push the market down, is that we formed an indecision candlestick, not really an indecision, but a reversal candlestick right below this downtrend, at the tip of this downtrend. And immediately this weekly reversal candlestick happened, the sentiment of the market changed. Assuming you took the trade at this level when this trend started, where I'm drawing this, you know, this horizontal line, assuming this was your entry trade, and at this point, since time is really rushing against us, I would kindly ask for your utmost, you know, I just give me all your focus on this one. I want to combine a few elements in all of these. I want to combine the topic of how to tell, I mean the subtopic of how to tell when a trend is ending, which I've explained a bit using the reversal candlestick that happened below at the close of this trend. And then something else, I want to explain the element of trailing stop losses. You remember, as I was starting, I said that we're going to be showing you how to take advantage of trends and how to make sure that you maximize your profits from trading trends. I want to combine these elements very fast, and therefore let's start from where the trend started forming. And we are assuming that you being in the market, this was your entry, you know, your entry point where you took the sell based on the new trend that is forming on this currency pair of the US dollar against the Canadian dollar weekly time frame. And I want to assume that the ideal place to, you know, place a stop loss based on this trade would be at around this price of 1773. And this is a place where, as traders, you know, it's a stop loss level, whereby whether I'm in the markets or not, if this market goes against me and gets to this level, then I admit I was wrong, and I'm willing to take up the amount of, you know, loss or risk that I have assigned for this trade. This is usually a predetermined risk management plan that you should have even before coming to analyzing markets. We cover risk management extensively in our Forex course. That's a topic that we can organize for on its own. It's a whole topic. But I want to explain you this element of trailing stop losses real fast to just make sure that you maximize on your gains on when you're trading trends. Then if I was you and this was my entry point right here and on top here was my stop loss, then my ideal place to set my take profit would have been around the price of 0.466, because this gives me a realistic level or risk to reward ratio of at least 1 to 2. But then you see, after the trend has started forming and it's a strong bearish trend, and at this point the market is, let's say, on this level of your take profit, but from the way you can discern the market and how the trend is strongly trending, you can tell that this trend will continue, the downtrend will continue, and there's a skill we call trailing stop losses. This is where we adjust the stop loss so that our trade is trading at a zero risk risk level. What do I mean by this? This is our entry. Let me just put some text on this one. I want to just put some text. Allow me, give me a few seconds. This is important for me to illustrate this with some text. So this would be would label this as our entry level. This would be our entry level. I'm just using the tools that are available to us by the MT4, that is the EGM MT4, for a basic trader out there who is just starting, and this is how you put text on your charts and label things if you want to type, if you want to mark your levels and all that. So assuming this was our entry level, and then this is our stop loss level, I mean take profit level. This is our take profit level. Remember, I want to explain to you the concept of trailing your stop loss to make sure that you maximize your gains when you're trading trends, when you're riding with the trend, because the beauty of Forex is that you might open 2 positions in a month, and those are enough to get you going. As you don't need to do 10 trades in a month, or every day you need to open a trade. It's not your need that guides you to open trades, but opportunities. And if, let's say, you take full advantage of such a trade whereby you ride the trend until it ends, this would earn you profits that could last you even 2 months or 3 months in your account. And you don't need to over trade. You just be patient and wait for the best setups. This is why I feel it's important for me to take you through this concept of trailing stop losses. So this would be our trade setup. This would be our stop loss level up here. This would be our entry level where we open our position, and this of course would be our take profit. But assuming our trade is approaching the take profit and it's about to close, but then you discern from the markets that there's still bear power to push this market further, then it would be ideal or logical for us to move our stop loss to such a level as this, and therefore this would be our new stop loss. What this means is that based on where our entry level, you realize our stop loss is now below our entry level, which means we have locked in some level of profits. That is from our entry level to our new stop loss, which is now below our entry level. And therefore, whatever happens, if we are wrong and this market comes up against us, then we're going to be stopped at this level, and we're going to lock up the profits that are between our entry level and our new stop loss level. And then, of course, this would mean we trail our take profit and move it further down here, so that this would further give us probably a risk to reward ratio of around 1 to 4. If you take a trade and you realize the strength is actually greater than where I even placed my take profit, and you trail your stop loss to be lower than your entry level, that is in the case of a bearish trend like this one, and then of course you shift your take profit down further to make sure that you maximize on earning the best profits you can get from this trade. This is a skill we call trailing stop losses. Especially we do this when the trade is in the money. When your trade is making money, we refer to it as that the trade is in the money. When your trade is not making money, we refer to you as being out of the money. And therefore, if you are in the money, your trade is in the money, it's making money, and then you come back, you reanalyze the market, and you realize that this is actually a strong trend, and we have every reason to know that this trend will continue, then this is where we apply the skill of trailing our stop losses, whereby we move our stop loss lower to lock in the profits up here, and then give the market a space to continue rolling on our side. But this is purely a skill you develop with experience, to discern the markets and tell when a trend is most likely to continue based on what we can see, how strong are the bearish candlestick in this case. And therefore, this is it. That's the element I really wanted to cover. I think we left with one or two. We covered how to tell between a weak trend or when a trend is ending. I've shown you the indecision candlestick, whereby, let me just come back to this. You realize this pin bar, that is the reversal candlestick. Let me just label it right here. This is a pin bar, which is a reversal candlestick. Reversal candle. What such a candlestick informs us is that if I was in the market and I was in a sell position, if this candlestick formed and my trade is in the money, I would immediately exit this trade with the profits that I've made so far, because this is a signal that this trend is almost ending, or this downtrend, and therefore it's a signal for me to lock in my profits. If I was wrong and the trend continues, the beauty of Forex is that you can always jump back and roll further with the trade. But then as I always say, the first goal of a Forex trader is preserve your capital. The second goal is preserve your capital, and the third rule is preserve your capital. And it even applies more when your trade is in the money and you're making profits, and therefore never allow your profits to be washed out in the market. And if this candlestick form, this is what informs the weakness, or that the trend is almost ending. And you see what happened after the reversal pin bar formed is that the trend, the sentiment changed and moved back up. Before I come back with my final thoughts on this topic, I'll just ask George to come on board and share a few sentiments. Then I'm going to take it back and point at a point or two. Then we're going to take another 5 minutes to address some of the questions that you have raised, and then then we can wind up on our today's session on trends, as we're really running out of time. So kindly, George, any sentiment you'd like to share on this topic of trends, strength of a trend, trailing stop losses, just anything, share with our audience.
Thank you, Josh. So what I'd like to finish off with is the topic about how to know how or when a trend is going to end or weakening. Honestly speaking, from experience as a trader, it is really, really difficult to know the exact end of a trend and the exact beginning of a trend. It takes a lot of skill, a lot of experience, and these markets are very, very elusive with the ends, the bottoms, and the tops of a trend. But there's one thing I'd like to tell you guys that will really help you for your exits. Our entries are more, like Josh has explained, how to enter breakouts, for breakouts, wait for the confirmation. It's showing you where the stop loss level is. But for the exits, even the experienced traders, many years after they began trading, they still have problems with knowing when to exit. When is the trend going to end? But what I will tell you is, you will never really know that this is the bottom until it actually bottoms, or really know that this is the top, but until it actually tops. But the signs are very clear. The market will throw signs all around before it actually tops or before it really bottoms. So be vigilant for the signs. You will never know exactly the truth, but the signs are there. Your work and my work is to watch out for these signs. Watch out for these signs. Act on these signs. Doesn't make sense. You know that something is going to happen and don't act on that information. So really watch out for the signs of the trend weakening or when it's going to end. And Josh has really done a good job of showing the candlestick formations. You have chart patterns, they form at these points. The market starts to, for example, maybe something I'd like to add. If it's an uptrend, the market is forming a higher high, retraces, forms a higher low, forms another higher high, retraces and forms another higher low. If the market forms a high that doesn't break the previous high, such are signs that the market might start consolidating. If it forms candlestick formations like reversal candlesticks, like in our course at FourthStreet Consultants, we have really expounded on candlestick formations for continuation patterns, for reversal, for indecision. So when the market throws these kinds of candlesticks around, especially reversal candlesticks or indecision candlesticks, a high doesn't close above the previous high, or for a downtrend, a low doesn't break below the previous low. These are signs. Watch out for these signs. Act on these signs. Back to you, Josh.
Thank you, George. You talk so passionately when you're discussing about forex, and I believe our audience really grasp the significance or the importance of everything that we're covering, because at Fourth Street Consultants we believe in giving people the truth. I won't lie to you that we're going to teach you or you're going to learn how to trade forex, and then the following day you're making I don't know 20% returns on your capital or whatever. The question is, when you're making that, is it going to be for the long term? How much of your capital are you risking to make that? And therefore we teach our students to approach forex as a business. It's a risky market, and so you need to shield yourself against the losses and risks of the market, and therefore we approach the market with a very conservative risk approach, and this is what we teach our students. You will make some good money consistently, and that is of the greatest essence to us, not to be rich overnight, because it's not possible. I wish I could have done that 9 years ago, 10 years ago, when I was starting to trade forex, but I have been learning across the years, and I can tell you for sure this is not a get rich quick scheme. You need to learn, you need to know what works, you need to get mentorship, you need to get guidance. The topics of risk management, trader psychology, price action patterns, how to draw lines of support, whether it's trends. You need education, and it's always advisable to invest in a reputable education platform or trainer. The last of the topics I want to cover as we conclude on the topic of trends is on trend retracements. I'll just take like a minute or two to just wrap it up using this topic. I mentioned when you were starting at some point that what if you missed out on a trend? How do you come back to catch up on that trend? And I'll just, by defining retracement, a retracement is a general flow of prices in the opposite direction of the main trend. During retracement, price generally retraces approximately 38 to 66% of the primary trend or the main trend since the termination of the last retracement. A point that George mentioned in our last commentary was that when a trend is forming, and I also mentioned this earlier, is that it forms some higher highs for an uptrend, and higher lows for an uptrend, and lower highs and lower lows for a downtrend. And I'm going to be showing you how to catch up on a trend in case you missed the start or the beginning of the trend. What we have open on our chart on the pair of the Great Britain pound against the Japanese yen, commonly known as a monster, is a downward trend on the daily time frame, and therefore they keep this downward trend. I'm just going to draw a vertical line showing, this is the direction of the trend of the market. But something of even more importance I want to cover at this point is there were significant higher highs and lower lows retracements that formed, just to indicate, just in a second. So this is lower high, so these are the points of when you talk about retracements, this gives traders second chances of taking up the trend and riding with the trend. You see these levels right here. I'm just going to highlight them using an eclipse eclipse there, and this zone right there, this it's our second chances for traders in case you missed to catch up the trend in the first go when the trend was forming. Then these retracements gives traders or us traders an opportunity to catch up with the trend. And therefore what would happen is that this is where the trend started, and then you take your sell positions, you set your levels of take profit and stop loss nicely and professionally. But then if you missed out, let's say you weren't in the market when this trend was happening, or you weren't quick enough to catch it, then these lower highs are perfect spots for us to re-enter the market. And even better is that this, by the time these retracements are happening, and they happen, and then the sellers take over the market and pushes the prices lower, this even gives us more confidence to take this trade in the fact that this is actually a downtrend, and although buyers are trying to push the market up and retracing the market a bit, sellers are still in control of the market. And what a better position to open a trade or join in the trend after you have confirmed that actually this is a downtrend and that sellers are actually in the long-term control of the market. And therefore I call them second chances for traders. I call them second chances. Retracements are second chances, and they are confirmations for us price action traders to open our positions and just analyze the forex markets and join in and ride with the trend in case we miss to take the top or the bottom of the trend. This was important to cover. And what if I told you that there are some big traders out there who trade purely based on retracement, whether it's a retracement in a ranging market, whether it is a retracement in a channel. We talked about channels in our last webinar, and consolidation. There are traders who trade on retracement because they believe that retracement reassures them of their trade entry and the fact that this is a proper confirmation for them to actually set up a tighter stop loss to make sure that they risk less of their money. And more importantly, they are almost sure, because you can be 100% sure in this business, but the probability is like 80% that this is actually a downtrend and this is a viable trade to take. And therefore this is how you trade retracement in a trending market, because as I stated, not all trends move in a vertical line or upward, whether it's a bullish trend. Some trends that are weak, like this one is an example of a weak trend that has a couple of retracements, and these are second chances for traders who did not catch to ride with the trend right from this beginning. And it's a good opportunity to come back, reanalyze, and spot these turnarounds, retracement, where buyers are trying to push the market up, but then sellers taking over back the control of the market. I think I'm going to end our today's webinar at that point. We've already exceeded our time by close to 20 minutes. I'm going to ask George, I don't know whether we have some questions that we have from our audience. We can tackle one or two. Then we call it, we end it at that point. So George, what are some of the questions that we have from our audience?
Thank you, Josh. So some of the questions that our audience have been asking. So one of the questions is, how many candlesticks must you wait for a confirmation candle? So how many candlesticks, probably after a breakout has happened, how many candlesticks should you wait in order to place an entry into the market? So I'll give you my 2 cents about it, then I will hand it over to Josh to tell you his answer about all these questions. So mine is, it is not really about the number of candlesticks, but it is about the quality of the candlestick. What kind of candlestick is forming as a confirmation candle? Is the candlestick showing decisive direction or decisive decision in the favored direction of the breakout, or is it showing indecision as that we've not really made a decision to head this way? So, for example, you've had a breakout. I don't know if you guys can remember the where if I'm sure you can see, or well, Joshua showed the breakout that we saw earlier, and the confirmation candle. It is sharing on the screen right now. If you can look at it, it is a candle with a very huge real body. So such candles are what I would like you guys to be looking out for. The decisiveness of the candlesticks, the quality. This candlestick has a really huge body with minimal, no or very little shadows, an upper or a lower shadow. So this shows that the sentiment of the market has been made. It has been decided that we are going down. And if you can see, the next candle was an inside bar, also something that we cover in our course at FourthStreet Consultants. Then, as you can see, the market really bled off downwards after that breakout, after the confirmation. So really, I would advise you guys to look at the quality of the candlesticks. It's not about the quantity. Is the candlestick decisive? Does it have a real huge body? Even for candlestick confirmation, even for reversals, a pin bar has formed. Wait for a really huge candle with a huge body, or a marubozu as we call them in the forex market. So I'll hand it over to Josh.
Yeah.
He'll tell you more about this.
Thank you, George. That was actually, I can add little or not to that. George has been elaborate. When it comes to the strength of a trend and how many candlesticks should inform your entry point, it's not actually a question of how many per se, but is more of how do you discern the strength of the candlesticks. An average takeaway point would be 2 candlesticks, but I wouldn't state that as a rule. It depends on the strength. You might find 2 candlesticks that are not quite, strong, and that does not inform us to as a confirmation of our entry. But you might find 2 candlesticks, or our single candlesticks, one very strong, the other one averagely strong, and therefore, as George stated, it's all about discerning the strength of the candlesticks that are forming. But the rule of the game is that it should be more than one, at least 2 candlesticks. Then you can discern the strength of these candlesticks. If it's, it tells us or informs us enough that these 2 candlesticks, the bodies are quite formed and the tails are fading, as George has explained, then that should inform our entry point. So it all depends on how strong the candlesticks are. Is there another question, George, you can tackle very fast?
Yeah, I will mention another question and also our last question.
Yeah.
The question was, when you're trading the weekly time frames uh, on placing your stop loss, how do you adjust in terms of your capital and your lot size to accommodate a wide stop loss? Because on the weekly time frames, you will notice that the stop loss distance tends to be quite wide. So my take home on this is that uh, adjust your lot size to accommodate the stop loss distance. Also, this is also covered in our course, how to calculate your stop loss distance, your lot size according to your stop loss distance. But what I feel the one who asked the questions really wanted to know is, for the weekly time frame, I have a wide stop loss. How do I trade such trades or such setups on the weekly time frame with the amount of capital that is available? Adjust your lot size. It will be quite less to accommodate a wide stop loss distance. But since you're looking at the market from a higher time frame, you're moving with the big boys, as we say. You're seeing the general direction. You're seeing the movement of the major trend. So if that trade goes to your direction, if your analysis was right, you will have a longer distance of riding that trend. It will be one trade. You might find just one trade stress free, gives you a home run, and in the end, you have a small stop lot size, but you're going home with the bag at the end of the day. You're going home with the lottery because as in as much as your stop loss is little, you have a good run of the trend because you're viewing things from the higher time frames. You are seeing what you can see in the lower time frames. In the lower time frames, there is noise. Like Joshua stated earlier, there might be whipsaws due to probably economic events or things that we call forces of nature, things that you can't control. There may be choppy markets within the lower time frames, but from the higher time frames, you will be able to filter this out, ride your trend smoothly, and once the signals come to exit, the trend is weakening, you exit the trend, and you find that you have a good amount of pips, and that will give you enough dollars, even though you had to adjust your stop loss to accommodate the wide stop loss distance. Back to you, Josh.
Thank you, George. That was quite elaborate. Thank you for that, for expounding on that. As you were explaining, we would summarize that question into two aspects. The first one is money management. No matter how wide you are spacing your stop loss, whether it's on a weekly time frame or it's on a daily time frame, we work the mathematics of risk management from back to the front. You have, let's say, you have a $2,000 account. Your risk management amount that you've designed per trade, let's say it's 1% or 2% of that. That money is what guides you on what lot size, to use based on your level of stop loss. And this is what guides you. And therefore, whether you're trading on the weekly time frame and your space is too big, and at the end of the day, based on your risk amount, you have to use a smaller lot size. What you need to bear in mind, as George has explained, is that you're using a weekly time frame, which means your distance, most probable of the pips that you're targeting, is more, and therefore you might need to be patient for a few weeks, but what you stand to earn is of significance. That is a question of money management, and again, patience to wait for your trades to work out. At this point, I think I'm going to call it an end. We're almost 30 minutes late. We are running on a 1 hour and 30 minutes. The webinar was supposed to go for 1 hour, but I really appreciate your patience and you engaging with us. Thank you, George, for making this a success, and our partners, EGM. At this point, I would just like to remind you that we will be conducting our third and final webinar in partnership with EGM, that is us, FourthStreet Consultants, the coming Tuesday. For those of you who would like to join us in our webinar on Tuesday next week, same time at 3 p.m., kindly follow our social media pages that is EGM Securities Facebook and Instagram. You can check out the link there to register for next week webinar. You can as well visit our Facebook and Instagram pages, as well as our Twitter at 4th Street Consultants. Just check 4th Street Consultants on Facebook and 4thstreet.consultants on Instagram, and you'll find the link to register for the third and final webinar that will be conducting next week on the same day and time. Those of you who probably have tuned in late, or you'd like to go back and listen to this webinar discussion on trends, how to identify trends, and the amazing content we've shared, ideas and strategies and wisdom on trading, you can of course feel free to visit EGM YouTube channel, EGM Securities YouTube channel. Going to be posting this all video there, as well as 4th Street Consultants YouTube channel. We're also going to add the link to the social media pages that is on our Facebook and also for EGM Securities Facebook page. So feel free. A few hours from now, this video will be available on the YouTube channels of both EGM Securities and 4th Street Consultants. Therefore, at this point, without further ado, I just want to thank you. Thank you for, finding time, setting up your coffee, joining us in this wonderful discussion. I think, as always, I had fun sharing and engaging with you, and I look forward to more of this. And for you who might have more questions or inquiries, please feel free to contact us on our on our website. We have our contact information on our website that is open on our chats. You can look for our contacts down on our website. Our offices are located at Karen. Feel free to call in our office line, and you're always welcome to come and consult, and you can inquire about the course, what it helps you, what it equips you with, and all the other questions that you might have. Even though you're not taking the course, you might just come and want to consult or ask a few questions. We welcome people. We open Monday to Friday, 8:30 to 5 p.m. And therefore, I think we'll end it at that. Thank you on behalf of EGM Securities for making this happen. Thank you, George, my fellow consultant at 4th Street Consultants. And thank you, our audience, for tuning in and being part of this amazing seminar. And therefore, I think we can, end it at that. And I just say, I wish you the best in your trading endeavors, and all the best, and God bless you.